Hi, and welcome back to Channel 11. I'm your host, Kent Shinoda. Today is Friday, November 18th, and I've got Graham Hopper with me again, the head of our advisor group that covers many of you listeners out there.
Thanks for having me, Ken. Thanks for talking with us, and this will probably air around Thanksgiving, so happy Thanksgiving to you.
Happy Thanksgiving to everyone out there. So today we're talking about opportunities in fixed income. It's been a rough year. Bonds are down a lot. And that means that yields are up, bonds down, yields up, and opportunities are present in many pockets of the market. And we're going to talk about the bond market broadly today. So I'd like to start here. This is a pie graph of the index, and then the core plus bond category average, which basically goes out there, takes a bunch of bond funds that are benchmarked against the ag in that core plus category and says what do they own on average, so we can see kind of what people in the market are doing. But first, let's talk about the index. The index today is a little more than 2/3 in government guaranteed type assets, Treasuries and agency mortgage-backed securities largely. The corporate credit used to be a larger part of the index, but because corporate credit, when I say corporate credit, I mean investment grade, is down the most this year, one of the hardest hit sectors because of its duration. Mm-hmm. It's become a smaller percentage of the index. But what's really important to think about when you're looking at bonds in your portfolio, what gives you the risk off hedge in your 60-40, it's not going to be owning S&P and high yield. It's going to be owning S&P and low risk assets, high quality assets. And treasuries through time, over the last 10 years have had a slight negative correlation to equities. Agency mortgages have had a very low correlation to equities. Corporate credit has a higher correlation to equities, not as much as, let's say, high yield, but it still has a higher correlation. So you need to think about having that safety in your portfolio for the 60-40. Of course, this year, correlation went to 1 on stocks and bonds, and both went down. Yep. And that's really what has hurt portfolios out there, that usually those things move inversely. In 2008, bonds kind of were flat while stocks were down a lot. And this year, of course, everything got hit in that 60-40. So on the right-hand side is the core plus bond category average. Most managers out there are credit shops. They're really good at corporate credit. Yep. So what they do is they underweight the safety. They underweight government guaranteed assets, including those agencies. You can see that through October 31st, credit in most funds was 55%. And then they try to add yield to the portfolio by going into different types of corporate credit, obviously investment grade since it's in the index, but also things like high yield and bank loans, and securitized credit, which is about 15% allocation in the average fund out there. And most managers, what they do is they don't want to make too big of a bet against the duration. They don't want to underperform the index. So they kind of hug the duration of the index and they add more credit and they try to pick up yield and try to outperform that way. And unfortunately, this year that didn't work. While if you had hugged the benchmark duration, you would have lost the same amount of price movement for rates. The problem is if you own more credit spreads widen. Right. And so as a function of that, a lot of bond funds out there this year are behind the index because of that spread widening and owning more credit than the index.
And I look at these charts, and my team and I spend so much time talking to allocators about fixed income in different parts. To your point, so many of other managers out there, not that they do a bad job, but that is where they focus. And that's really where there's a comfort area almost, because it's what our clients hear about so much is corporate bonds. And I think that's why, one of the reasons why today is so important, where we might talk about some other parts of the market and what's going on. But to your point, a lot of the moves, which we'll see here shortly, have been duration driven.
That's right.
Off of this.
So here is a 10-year correlation. Look back, just what is the correlation of the different pockets of fixed income to the S&P 500? And the very bottom, you see Treasuries and long Treasuries, they have that very ever so slight negative correlation or zero. Let's just call it zero at this point. This year skewed all the numbers because it was a very highly correlated year.
Everything down.
Very short ABS and Agency MBS also have very low correlations. The Ag 0.24 there, and then as you go out the spectrum of credit risk, the correlation increases. IG kind of right in the middle, and high yield the most correlated, and it makes sense. Often high yield leads the S&P down. This year it didn't at first, but just something to think about as you're creating asset allocations for your portfolios is acknowledging the correlations of the different pockets of credit, and also that the lower correlations come from the safety type assets.
And I know it's elementary, but if we think about fixed income as an asset class broadly and how our allocators use it, what's it for? It's for a lack of correlation to the risky part of the portfolio. It's for a lower volatility, smoother ride. People stay invested in the overall portfolio, and then income. This clearly lays out those areas, and the areas where a lot of overweight has been, because it's worked over the last decade by and large, are the things that are the most correlated. So now that we're getting into an element where there actually is yield, which we haven't seen for quite some time, this could make this even more important.
Yeah, so one thing I'll just note on this too is that a lot of the securitized sectors, they are shorter cash flows, which I think also lowers some of the correlation because the volatility is a little bit lower. But some of the securitized assets are on the lower end of the correlation relative to some of the riskier parts of fixed income, like corporate credit, like high yield and bank loans. Here's the vol of the different components of the index, and you can see that agency mortgages typically are the lowest vol of those asset classes until this year. Obviously, vol picked up across all of fixed income, and agency mortgage spreads widened a lot as we unwound QE, and QE turned to QT, and it is one of the cheaper assets on a historical basis, and we'll get into that later. But just this shows you that investment grade, obviously the most volatile, and then Treasuries, and then mortgages at the bottom there.
I love this slide, and we've had it since I've been here at DoubleLine, and it continues to surprise allocators when they look at it, that agencies, anything mortgage related, could potentially be the
vol dampening.
Vol dampening and one of the lowest rolling volatilities. And if you extend this chart back to 2008, same thing.
It's the same thing, yeah. We should probably extended this further back, but nonetheless, this is a quick snapshot of that. And let's take a look at the markets now. We're not done yet, although many of us wish that the year was over. We're almost there. We got
just means more opportunity going forward.
Month and a half left. So the ags all the way over on the far right-hand side, down 13.6 now. It was down over 15% at one point, but we've had this rally here. And on the far left are the different components of the ag agency MBS index, down 12 plus, Treasuries down 12 plus. It's really the IG component of the index that has gotten hit the hardest. It's come back a little bit. At one point, IG was down about 20%. What's really held up has been bank loans and floating rate assets. So bank loans, one of the top performers, the index only down 1.5. BB bank loans actually up 1.9, the only thing up. And those shorter securitized assets, while down, are down a little bit less than the other parts of the fixed income market. So that's that kind of shortness in structure. They tend to have either collateral that's shorter, or the way that the capital structure works makes the bond shorter. So for equal movements, higher in rates or wider in spreads, they just go down less in price. They have underperformed corporates from a excess spread standpoint, meaning if you take duration out of the equation, the spreads have widened more, which is why we think certain pockets of the securitized market look really cheap right now. And we have some data to show you why, and go back through history, which is an important exercise to do. Before you do that, let's talk about rates. It's obviously on everyone's mind, and the Fed. The market's pricing in terminal Fed funds around 5 plus or minus, depending on, which Fed speaker is talking that day and how the short end moves. But one thing kind of to think about is the term structure And a lot of people are concerned that the Fed's going to just keep going, which could happen because the economy's kind of a mixed bag right now. Housing's doing really poorly. Some economic indicators are weak, but at the same time, unemployment's very low. Job openings are high. Retail sales came in okay. And so it seems that could give the Fed the ability to maybe move higher than that 5%, right?
It's kind of amazing that the most recent print at 7.7 on headline was the impetus for a massive move in rates down. It's still 7.7 on headline.
And the trend probably keeps going down because of year-over-year numbers. But why I wanted to show this, and this shows basically Fed funds is the blue, and looks like you go up a ladder because they do those incremental hikes, and then the darker line is the 2-year. As you get towards the end of the hiking cycle, there is typically an inversion. So in the bottom, those beige shady things. When it goes below 0, there's an inversion, meaning that the 2-year starts believing that we're towards the end of the cycle, end of the hiking cycle, or hiking has stopped, and that eventually the short-term rates will fall, or the Fed funds will fall, and then the 2-year gets inverted to Fed funds. So one of the ways I think about kind of where long-term rates could go kind of in a worst-case scenario, if they haven't already peaked, is we say, okay, a lot of people, the worst-case scenarios I've heard out there have been something like 6% Fed funds. Well, if you look at the bottom, during the end of the hiking cycle, you get, in some cases, over 100 basis points of inversion 2-year to Fed funds. So a lot of people ask me about, like, what's the worst-case scenario? What if the Fed goes to 6? Well, I say, based on looking at history, if the Fed funds went to 6 and that was the end of the hiking cycle, there's probably some inversion to the 2-year. If you just say, okay, 100 basis point inversion, roughly, sometimes it goes even more, like in 07, that would put the 2-year at 5. We almost got there, by the way. And then there will probably be an inversion to 2's tenths, something like 50 to 60 basis points. And, that would take the 10-year to 440 if it was 60 basis points. And guess what? We were almost there. We were like 430. Yep. And so that's kind of, I think there's going to be a decent amount of support at that 450 level if we go test it. We may not get all the way back up there, but for those that are more hawkish and still negative on rates, I would say that buying the 10-year somewhere, now from where we are today up till 4.5%. Obviously, everyone wants to buy it at 4.5 and not where it is today, but we do think that sometime over the next 12 months that you'll probably be making money on that investment, and rates will probably be lower as the economy slows. Maybe it doesn't slow immediately next year. Maybe the economy is stronger than people think, but at some point through next year, we think that buying Treasuries at the levels that they are today does look attractive.
I think the implications of what you just talked about, and we have a slide a little bit later about it, but where we are now versus a year ago, where a 50 basis point move up to the high side on the 10-year was a big deal to total return for the ag. And now, because the amount of carry that's in the ag, how it's much less consequential, and you still end up with a positive return if that happens in most cases.
That's right.
And I think that's really important that people are starting to wrap their arms around right now.
Yeah, we have a good slide on that, and we'll get there in a second. Why don't we go there now first? So here's the yield on the ag. It got up north of 5. It's come down a little bit with this rally. But now that you have yield, you had almost no yield. I mean, the low was 1%, right? 1% with a duration close to 7 in 2020. So if you went up 100 basis points, then you'd lose 7 points. You'd earn 1, -6. Rates obviously went higher, up much higher than 100 basis points. But now that you have yield, you now have so much more safety in fixed income. So here on the upper right-hand side is a chart that shows you if rates go down 100, what's the theoretical return of the index. If rates go up 100, what's the theoretical return? And so now you have much less downside. If rates rise 100, you would have a -1.5 return because you have enough yield to protect you. So that's something that's really important to think about in fixed income. We've taken the pain this year, and so the probability of negative returns declines the higher that yields are.
Right.
So this is the ag through time, every single year since 1978. And if you have a positive return on the ag, the bars go up. If you have a negative return, the bars go down. This is the first back-to-back negative years ever since the ag was started being tracked. And what the beige lines are those are years that rates rise. So there's many years in the past when rates have risen, and this is the 10-year yield rising, where you had positive returns in fixed income because you started with high nominal yields.
Right.
Right? And the dots, those are the max drawdowns of the index. So the index at some point being negative. So let's say the index goes negative early. You haven't had time to earn the carry yet. Right? And so that's why you could have that big drawdown at the beginning of the year perhaps, but then through the rest of the year, you earn your carry. And back in the 80s, you had some pretty big drawdowns because rates were moving around a lot, but you also had really high yields.
Yeah, so much, yeah.
And so during that time period of all this kind of scary high rates and volatility, you still had positive returns on fixed income. There have been very few negative return years, and of course this year being the worst.
You look back at the early 80s or late 70s into early 80s, there was all that. There was so much yield in what was 15% yield, give or take, in that situation. You look at 82, it stands out, 32% return. Half of that was probably from the income generated.
Yeah.
But there was a big bond rally after sequential years of rates coming up and it being a relatively tough bond market. I don't think that any of us would extend that and say, wow, we've had 2 bad years in a row. We're looking for a 30+% return. But that said, the opportunity for upside for positive returns is much, much better at this point in time.
Yep. All right. So, okay, here's the kind of a page I've been using a lot in meetings with clients. We call it Assessing the Yield Landscape. And it's basically a bunch of different indices. On the left-hand side in the beige, these are the components of the ag and the ag itself. The yields look a little bit worse than they did at the end of the month because we've had this rally. But, the ag was 1.7 a year ago. Now it's 4.7. At one point it was north of 5. And so now you can go to high quality fixed income, get almost 5% in the lowest risk parts of the market. You can get almost 6 in IG Corps. And then if you add a little bit of more credit risk in different pockets in the market, you can create core bond portfolios that have 6.5% type yields, right? By adding a little bit more credit risk in there. You can create credit portfolios that are high single digit, low double digit yields using the bottom of the investment grade market and kind of the top of the below investment grade market. And if you really want to go for it and get equity-like returns, be cognizant you're going to have more volatility, you can now go into the below investment grade portions of securitized. High yield is a little expensive relative to securitized, and you can find assets that are in the mid-teens now, right? And that just didn't exist back in the day. I mean, you used to have to, if you wanted to get 6 yield, which is basically what corporate bonds yield today, you used to have to lever up high yield because high yield yielded like 4. So you'd have to put a turn of leverage on high yield to get kind of a 6 to 7% yield.
There's a couple things here. I look at it, and it's just so stark to me where it stands out. Agency MBS currently yielding about 4.7. A year ago, high yield corporates 4.4.
That's right.
All in. It's just so stark. And I think back to one of the big banks put out a report last year where they surveyed their wealth management teams. And the weighting to traditional fixed income was the lowest in history at that bank, basically about 17% overall weighting of public fixed income. This chart says to me, we are no longer in the TNA or there's no alternative environment.
Yeah.
If you want to get 7%, 10% plus, you can do it in the fixed income market on assets that are much cheaper now than what they were. And the prospects look great.
Yeah, I mean, just think about the average core plus fund out there probably has a yield somewhere between 6 and 7.
Yep.
Maybe a little bit lower after this rally. And that's the long run return on the global equity, roughly. And so there you go. There is an alternative now. And I think investors should take a really, really hard look. It does seem like we're not the only ones saying that now. There's a lot of other CIOs of different broker-dealers out there, and the advisor universe are on there, and other money managers obviously. Maybe a little bit self-interested because we are bond fund managers after all. But
fair enough. It's been a long time.
We've waited a long time for yields to come back up here. It's been almost 10 years since we've seen levels like this. So,
and then I think the important part about that is, because you're right, we're not the only ones doing it and saying that. But then going forwards, how do you do that? And I think that leads to the next couple of slides you're going to go on.
Yeah, okay, so just looking at yield isn't necessarily helpful. You kind of want to see where have yields been. And I just did the last 10 years. Obviously, you can go back 20 years, but some of these indices didn't exist 20 years ago. So this does throw the global financial crisis out. But if you include the global financial crisis and you say, I want to buy yields when they're at their highs, you would basically never buy anything because you would always be waiting for the global financial crisis again. And I'm sure there's some people out there like that. But nonetheless, let's take a look at these. The index, the safe stuff, or the safer stuff, the stuff that's in the index, investment grade bonds, Agency MBS, Treasuries, the yields are close to their decade highs. The triangles, the silver triangles, are all-in yields. The blue rectangles, or I guess squares, are the average. And the average is manipulated lower by QE. So, one of the problems with looking at the last decade is that, there was a lot of QE that went on. And the reason that the bars in some instances are higher is because we've got March of 2020 that is in this 10-year time horizon. So one can look at this and say, well, I want to buy high yield at 12 because it got there. It wasn't there for that long because of the Fed stepping in. But yeah, high yield, if it got to a 12 yield, that would imply kind of an 800 OAS, and that's kind of where it gets to over during recessionary time periods. Sometimes it goes a little bit higher, but high yield definitely looks cheap if it's at 800. So what you can't just do is look at yield. You have to look at spread, right? And you have to look at spread through time.
Right.
So what we put together on the bottom is a percentile rank. So let's just take Agency MBS, for example. 97 percentile rank means that there's only 3% of the days over the last 10 years that the spread was wider than it is today. And at the end of the month, that number was 99. Spreads have come in a little bit on agency mortgages.
Yep.
And on the far right, you see a lot of the securitized market and bank loans is in the greater than 90th percentile. So those are screening, I'm not saying screaming, screening cheap. And high yield at 429 now is just 450 spread a couple days ago. And that looks expensive. It's on the lower end of the trading range. You've kind of been trading between 400 and like 600 on high yield. So corporate bonds and high yield have rallied into this equity rally, and much of the securitized market has not necessarily enjoyed that rally. So they do look cheap to us going into the end of the year.
The standout there is obviously agencies, still sitting almost as wide as it's been in the last 10 years. There's a lot of talk right now of doing a barbell. We're talking about it, others are talking about it. And the way that I'm hearing allocators wanting to put it to work is, I'm going to go buy a proxy for the long bond, and I'm going to buy a proxy for high yield corporates. There you go. This is what we're going to do. Is this indicating maybe there's a better way to play that? As I look at where spread levels are in agencies, I look at securitized credit below investment grade, as well as investment grade looking wider. I think that's really kind of what I'm going to go to with that conversation. Maybe there's a better way than just do what everybody's used to doing and traditionally does.
Yeah, well, I mean, let's just talk about agencies. Everyone's been underweight, and if you looked at that core plus category average, and it made sense to be underweight because if you look on the left-hand side here, this graph, this is MBS current coupon spread. This is nominal spread, not option adjusted. And this is of what we call kind of par coupon. So it's kind of current coupon MBS. It's which mortgage coupon bond is trading around par. And it got really tight. Look, during peak QE, we were down kind of 70. During post-COVID, we got down sub 70 nominal spread. And that was below corporate bonds. So it made sense. Everybody was buying corporates over MBS. MBS had negative convexity. That's a measure of, one measure to look at prepayment risk. And you can see on the right-hand side, that's that convexity number. And it's usually always negative So it made sense. Corporates had more spread, didn't have negative convexity, and the Fed wasn't buying them, right? So what's happened since then is vol has picked up. Mortgage spreads have widened dramatically. I wish we did this on October 31st because it was the line on the left-hand side was close to the wides.
Yep.
But it's still pretty wide relative to history. But it got to the widest levels that we had seen since the global financial crisis and when Fannie and Freddie were going under, or people thought they were going under. They ended up going into a conservatorship. And then there was a week in 2020 before the Fed stepped in with their $500 billion mortgage buy program that by the end of the week turned into the infinite mortgage buy program. So spreads are very wide. They're not 99th percentile after this little move, but there's a lot of vol. Spreads could widen again. But more importantly, the convexity is positive for the first time in my entire career, and I got into this business in the early 2000s. And that's what makes it so interesting. Not only is the spread wide, just spread being wide by itself is good, but the fact that the spread with the measure of risk in the MBS market as measured by convexity is the best it's really been in a very, very, very long time. And that's what makes it compelling. And I want to walk through why it's like that. But do you have any thoughts before I do?
I look at the one on the left, and I'd like your thoughts on what I see on that spread widening is really the power of fear and narrative. And that is the Fed's going to sell agencies off the balance sheet. So people are not buying them or getting out of the way and selling them. And then additionally, on the slide on the right, and you might be about to be getting into this, typically, if we go into recession, if there is the flight to quality rally, Treasuries outperform agencies. Yep. They're both government-backed, but they outperform. Does that convexity profile lend this to it being a more fair fight this time if rates rally on fear or capitulation?
Absolutely, yeah. I mean, historically, when rates are really low, it's just hopeless to try to beat Treasuries and mortgages because you always have negative convexity. You always have rates fall, more people prepay. Mm-hmm. So I like to use kind of a simple example. Like you have a bond that's trading at 102. You think it's a 4-year bond. You're getting paid, the spread on it. It's 100, looks like 150 today. And you have two risks. A lot of people think about negative convexity, which is one of its call risk, and they just think about it for rates falling. So you own this bond at 102. The pool of loans is prepaying about 20% of pool on an annualized basis. And your risk is that rates fall and prepayments go from 20 to 60, right? And you thought you had a 4-year, and now you have a 1-year, and you can't go up much more in price. So that's one risk of mortgages is the rates falling callability aspect. But there's another risk. The other risk is that rates go higher, and instead of prepaying at 20% on an annualized basis, prepayments slow to 6, let's call it. Mm-hmm. 6 is the natural turnover of housing, even when your mortgage is out of the money. People still move, people still get divorced, they have an illness and they have to sell their house. Yeah, life happens. Yeah. Those risks have both diminished dramatically because most people, I hope, are in a 3.5% to 4% mortgage. Maybe some are lower, some are in a 2.5% mortgage,
right.
30-year fixed rate, and rates have risen a lot. So mortgage rates were 3.5, now they're 7. So 99% of the mortgage universe cannot refinance for 100 basis points of rates falling. 92% roughly cannot refinance for 200 basis points of rates falling. So at least for the next 100 plus basis points, there is a good chance that agencies can compete with neutral to positive convexity to Treasuries. And that's if you buy the index. If you actively manage and you go find better bonds that have a better convexity profile, mm-hmm. You can, I think, do better than the index.
And that's very different than normal. Now, you just referenced a bond that was at 102 and prepayments, rates falling, prepayments go up, 20 to 40, what have you. Bonds right now in this market are low to mid 80s.
Yeah, you can find bonds with lower prices than that if you, go to the low coupon parts of the Agency MBS market. But broadly speaking, so here's all the different indices we've been looking at. almost everything was at a premium a year ago. Not everything. Some things were at a slight discount, but when you buy something at 103, the MBS index was 103 handle. You're going to lose a little bit of money because you're getting par back one day. Right. And the yield is the coupons. The yield is lower than the coupon, and that's why it's at a slight premium. But there's no hope. There's not much upside in many of these pockets. But when you're at in the mid 80s, and at the end of the month it was mid 80s, we've had a rally. So now things are kind of mid to high 80s, but still they're pretty big discounts, and that gives you a lot of convexity, especially in the MBS market. And when you go to the credit markets, that gives you safety now, because now you have some cushion to losses because you're at a discount to the par balance of the debt.
Right. So let's say rates rally, and just to make it clear, this has the agency market at 88.2. Let's say rates rally, prepayments start to come back in play.
Great. I own it at 88.
Bingo.
Right?
And I think that's missed a little bit, where immediately, if you have prepayments, heck, even in agencies, if you have default, that's technically not bad if you own it at 88 because it goes to par. It's government backed, correct?
Yeah, I mean, in most securities, if the prepayments come in faster at your cost basis, right, your yield goes up because you're getting more cash flows. Eventually, as you approach par, that negative convexity kicks in.
It comes back in.
And you can't go back up north of par. But, rates have risen across the curve. Some parts are up over 300 basis points, right? Okay, so we talked about agencies, and they are, on a percentile basis, one of the cheaper assets out there. And now they have a neutral convexity profile, which I haven't seen my entire career. There are pockets of time you can find certain bonds that have that positively convex profile, but right now the index as a basket has a slight positive convexity. So now let's look at, let's start with securitized credit, because that's the pocket that really has kind of lagged recently. Corporates and high yield have rallied, and securitized has not. So today, IG corporates, the spread on the index is 128, and high yield is 461. So let's just keep that in the back of our heads. And so here we are. These are kind of benchmark transactions in the securitized space. So we took a generic kind of non-agency bond. The AAA, AA, single A are 2-year bonds, 2 to 5 year bonds are front sequentials, and then the BBB, BB are the second sequentials. They get paid next. They're a little bit longer. They could be 5 years or longer. And look at the AAAs. I mean, it's pretty amazing. This is month over month from November, and rates had already started rising by November of last year. The low was actually the summer of 2021, and some poor soul bought a 2-year AAA at the lows. We saw deal price. 2-year swaps were like 18 basis points, let's call it 20, and spreads at the tightest were kind of around 60 to swap. So some poor soul bought 2-year AAAs at an 80 basis point all-in yield. By November, it was already a 2 yield, it doubled in yield, and now it's up at 670. The front end has rallied. A couple weeks ago, that yield was almost 7.5. So almost a 7.5 yield for a 2-year AAA bond, money good. That's competitive to equities, right?
And per a prior slide, the 10-year average for high yield corporate bonds all in is 6.1. That's high yield corporate, which probably have a similar duration or length profile.
Yeah, so high yield corporate all-in yield is 8.8 right now.
It's 8.8, but the 10-year average was 6.1.
That's right. And so now you can go into the higher quality pockets of the market, and here's CMBS conduit. Those are 10-year fixed rate CMBS deals, a generic subprime auto deal, and a floating rate CLO that's backed by higher quality bank loans. And so the AAAs on all these assets, mid 5s to kind of high 6s right now, right? You go down the investment grade spectrum to single A. It's not even triple B, and now you're talking about 7-8% type returns, 8%, close to high yield, right? And if you go into the bottom of the capital structure, double Bs, now you're getting into the teens.
And can you define a little bit these yields that we're looking at? My belief is that these are loss adjusted yield to worst type assumptions that we're looking at here.
Yeah, that's right. Like in the corporate market, yields are quoted to no defaults, and often in investment grade there are no defaults.
Right.
But in the high yield market, through time, there's going to be defaults. So your yield is a yield to no defaults. So in reality, there's going to be some defaults. So you're not going to realize that full kind of 8-handle yield. There's some losses in there, and maybe you get some recoveries, and your return will be in like the 7s or something like that. Whereas we are running losses because we have collateral that takes losses, right? You have credit cards, subprime auto, there's going to be losses. But what happens is that the bond structure puts enough bonds below you to take losses before you get hit in order to make sure that you're safe. And subprime auto is interesting because the bonds didn't take any losses during the global financial crisis. A lot of people don't believe you.
I don't believe you.
Yeah, when you say that.
I've seen it. I don't believe it.
And the reason is that we knew that the borrower was going to default, had a low credit score. So the rating agencies in the market priced in the losses. They said, okay, there's going to be a lot of defaults because the credit score is low. The coupon on the loan was really high, so that gives you a lot of what we call excess interest to cover losses. And we knew it was a depreciating asset. So people assumed that when the car was sold, it was a used car and it would take a loss relative to its original balance. So we effectively and perhaps efficiently priced in the bad news. The problem with the mortgage market was that historically there hadn't been any losses. Home prices had gone up, consistently since World War II. And so the market was pricing in very, very low losses, and then losses went higher, right? So if you already are assuming bad things for the asset, you can price in the risk, right? And that's something that's, I think, interesting about the structured products sector.
Never a bad bond, just a bad price.
Yeah, kind of. But look at the AAAs in non-agency and RMBS and the AAAs at CLOs. I mean, they're 200. And if you go back through time and look at corporate spreads during recessions, they kind of get up to about 250, and that's right where AAA non-QM is. Not saying that it can't go wider. In March of 2020, it did go wider, but we're at levels that look very cheap relative to the corporate credit market today. The spread pickup isn't always this wide, and I have some slides to show you. High yield is now a 425 spread. You can buy the investment grade pockets of some of these securitized markets, like the BBB non-agencies at a 590 spread, the BBB CLOs at a 500 spread, ABS subprime auto BBBs are kind of right on top of high yield junk bonds, right? So you can buy investment grade bonds with the same spread as and or more spread than the high yield market today. And part of this just has to do with technicals and a lot of selling out of bond funds and ETFs and things like that have pushed spreads wider. I think that one of the things that the IG and high yield market do benefit from is there is liquidity created in the ETF market and things like LQD, HYG, JNK, whereas the securitized market is more doesn't have that, and it's really comprised more of money manager, insurance, and some banks that buy it, and hedge funds, of course. Okay, so one question I get when I show that chart to people is, well, how wide does it get in the past, obviously, and how cheap is it relative to corporates? It's hard to show you a lot of data going back much before the post-global financial crisis era because of a couple reasons. The indices didn't exist for some of these sectors, and also the sectors have changed. So CLOs complexion look very different now than they did pre-crisis. CMBS, AAAs have more enhancement now than they did back then. So it's not really apples to apples. So take it with a grain of salt. But here's the data. On the top is AAA CMBS and AAA CLOs relative to IG corps as a basket. And the average is the dotted line. So when the line is below it, IG is cheaper, and when the line is above it, securitized is cheaper. And the securitized isn't always cheaper. AAA CMBS often traded through corporates because I think the average rating of the IG index is probably single A, and these are AAAs, and so they had perceived less risk. But now look there, it's the widest it's been since 2012 on AAA CMBS. AAA CLOs, floating rate, if you're still worried about rates rising. That's the widest it's been since 2012. And here at the bottom, we have triple B minus CMBS and triple B CLOs relative to the high yield index. And triple B CMBS is volatile, so can triple B CLOs be volatile. So maybe that's a good comparison to compare it to high yield and not IG. And you can see that on triple B CMBS, we're close to the wides. And on triple B CLOs, it looks like we are at the wides. So the widest it's been on a relative basis. So there you go. It's obviously higher yield, and so it has a wider spread. But people want to compare it relative to their other options, which is they can go by IG corporates, they can go by high yield. And here's that kind of additional relative value that you get going into these pockets.
I think that's exactly, you just said it right there. It's about the relative value across the bond market and complementing what you own. What we're comparing against is what the majority of managers and the benchmark own.
Yep, that's right. So another question that comes up is, okay, well, you did this 10-year look back, and but what about before? Are you trying to hide something from me with your data? No, we didn't. The data didn't mix well together, and so we have to remove all the securitized assets because a lot of those didn't even exist back in the late 90s. Most of the securitized credit markets that really started growing in the early to mid 2000s, and then obviously took off big in 05, 06, 07, leading up into the global financial crisis. But let's just look at, I got IG, high yield, and bank loans. And what we did is we show you the spread, and you can see that IG kind of can get out to 250. So in the early 2000s recession, it got out to, looks like 270 or so. Obviously the GFC happened. Then you had, looks like the European crisis in 11, it got out to 250. You had that kind of 2015-16 energy crisis, it got out to the low 200s. And then there's COVID, which, was a unique thing, I think, too. I think you have to kind of throw those out and just say, good old fashioned, not a pandemic, not, every bank in America is going under and everyone's defaulting on their mortgages, and just maybe a good old fashioned recession. Maybe we'll get lucky and have one. IG gets to a little bit over 200, right? And so today, what we did is we said, let's take today's spread and let's rank it pre-GFC, post-GFC, and over the last 25 years, including those time periods. And it doesn't really make it look that cheap right now.
No.
And a lot of corporate managers I've heard are out there saying the same thing. The move was a lot of duration, and spreads really didn't move much. Even our corporate credit team says that all the time. Just rates.
Had a call with Monica this
#just
morning.
rates.
Yep, that's it. Duration cuts both ways.
And but securitized and even bank loans look okay on that ranking too. But let's do high yield next. High yield, typically gets somewhere to 800 to 1,000 over, and that's a lot of people have that in their mind as that's the buy zone. GFC, it got to 2,000, and then COVID, we saw big buying come in from the locked up funds around a 1,200 over, 1,100 call it. But in, the other time periods around 800 is kind of where it got to. So relative to pre-crisis, post-crisis, it's even arguably more expensive than IG. And over the last 25 years we're 50th percentile, and that pulls in the GFC. So for everyone that tells me that, what about the GFC? We included it in there, and obviously that skews it a little bit. But you can even take out the GFC and you still get about the same percentile ranking. Bank loans, of all three, looks the best, but it is at the highest dollar price, and you don't have much price upside. They're floaters.
Right.
So you can find great credits in there, but if you talk to when we were at the kind of lows in high yield, talking to our credit team, Robert Cohen, who runs that, and he's been on the show before, they thought that selling bank loans and buying high yield at that point in time, if they had to put marginal dollars to work, they liked high yield, but high yield has rallied a lot. So right now, I would say they agree with my statement that it doesn't look cheap. They were buyers at 600, sellers at 400, if you will, on a spread basis, and we've been kind of trading range bound there.
The folks that are issuing bank loans, they're immediately impacted by the move up in rates. Whereas if you're looking at the high yield market and definitely the IG market, they've locked in those rates for quite some time. They're not feeling the pain of the rates coming up on their debt service, like the bank loans that are based off of SOFR.
Yeah, I mean, look, the high yield kind of refinance wall that everyone talks about is a couple of years out, and most companies locked in lower cost of funds. Some may need to come get more cash because economy's slowing down and maybe they need more debt, but bank loans, they immediately feel the effects of the higher rates because they all borrowed floating rate. And look at the spread over the is that average spread last 25 years is upper 500s. The post GFC spread looks like it's low 500s or so. And let's say SOFR gets to where the market's pricing in 5. It means their cost of debt has doubled, right? And look, the bank loans are secured. You can find great assets in high yield. You can find great assets in bank loans, but I do think, and we just had that a client event internally, and one of the questions asked was kind of like, what do you think people aren't necessarily thinking about that maybe they should be worried about? And I said, there's a lot of floating rate debt that's been issued out there that at some point, if short-term rates stay high and the economy slows, the cost of debt has gone up a lot for whoever the borrower is. That's going to induce defaults. And in some countries where they don't have this amazing 30-year fixed rate mortgage and they have floating rate mortgages, the coupons are already resetting higher and people have already started defaulting on mortgages. We're really lucky, and it's one of the things that I think will help the housing market and frankly Americans, is the fact that we have the Fannie Freddie Ginnie Mae program and all these 30-year fixed rate mortgages. And so floating rate debt is something that I think, if rates come back down, obviously that risk dissipates. But if the longer that short-term rates stay higher, the more stress will come perhaps into that pocket.
I just look at that chart. It seems to me spreads, a lot of the value in many parts of the fixed income market has come because rates have backed up. Again, we're just repeating what you said earlier, not necessarily spreads. Spreads are kind of average level, maybe a little bit of it, but there was some pain in spreads because you came off of darn near all-time lows in these major sectors of the market.
I think they're average in the corporate credit market, but in securitized, they're at much wider levels just using that percentile ranking.
I think that's
right. I mean, here you see IG gets to 250. We've got 250 spread on AAA non-agency bonds.
Right.
You see that high yield gets to 800-ish, 1,000. I can find you bonds at 800 or 1,000 in the securitized market today. So that's kind of one of the things out there that we're seeing is that securitized, for now, it hasn't rallied with high yield and IG, and that kind of tends to be the case. It kind of lagged on the way down. It was kind of outperforming, and then it played catch up. We also saw that in 2020 after the Fed stepped in. You had this huge rally and all sorts of corporate credit, and securitized tends to kind of lag a little bit on that front.
How do you see most recent memories? March 2020. It's a very different pandemic. As Howard Marks said, an asteroid hit the planet. That was the analogy he made. And then the Fed stepped in and did certain things. When it comes to that lagging or the participation, and maybe there's a margin of safety now, how do you see, let's say we do go into recession. Jeffrey at a recent conference was saying he expects recession around May 2023. Let's say we go into that, there's capitulation versus the high yield corporate counterpart versus securitized credit that is in that vein, or even IG corporate credit. How do you see the relative price performance there from your experience over the last 20 years?
Yeah, it's hard to say because liquidity has continuously diminished on Wall Street by the sell side. As far as the sell side banks historically you needed to sell a bond, they would buy a bond, put it on their balance sheet, try to hedge it, and then try to sell it back to you or one of your competitors, right? And make that bid ask. And it's not just for securitized, it's for all fixed income.
Right.
I mean, you talk to Treasury traders, and they tell you liquidity is worse now than it's ever been. So liquidity has decreased across all fixed income. It's just all relative. So to me, the Treasury market still has way better liquidity than, MBS and credit. MBS has better liquidity than credit. IG will have better liquidity than high yield.
Right.
So it's all relative. But the one thing that lack of liquidity does work in two ways. On the way down, there's less willingness and ability to balance sheet assets, so it makes spreads move wider faster sometimes.
Okay.
And maybe it'll make them go wider than history because there was perhaps more liquidity pre-crisis. But that means that if the street isn't buying it from you on the way down, they don't own anything to sell back to you on the way back up. And so you often have spreads widening because everybody is a net marginal seller of assets because of outflows, which is exactly what happened this year.
Mm-hmm.
Nobody wants to sell bonds at these levels, but they have outflows they have to sell.
Right.
And the street has been buying, but they moved it out of it, and some end accounts have been buying. But the street just still doesn't balance sheet anything like they used to. After the global financial crisis, they owned billions. They bought them on the way down. They tucked them away. You asked them if they had anything. They probably, I don't want to say lie, but they probably didn't tell you the truth, and they had them tucked away, and they were waiting for the prices to go back up. And then the prices went back up, and they said, "Oh, I have these bonds that I
check this out.
Inside my coat pocket here." And
I forgot
but
about
that allowed you to have assets to trade, and they made markets both ways, and you could express a view, and you could sell bonds or buy bonds, and they don't have anything now. I mean, they have very little. So what happens is when the market turns and money starts coming back into the buyer base, money managers, hedge funds, you name it. Everyone turns from a net seller to a net buyer. Whatever the street owns will get bought immediately. They will now turn into net buyers to try to replenish their balance sheets, to try to make money on the way up. And you'll have to go to the new issue market to buy any reasonable size. And the new issue market becomes a total food fight. You put in an order for the whole thing. I want a $500 million deal. I'll buy the whole thing. I'll buy the AAAs, the AAs, the single A's, the triple B's, the double B's, the single B's, and I'll put them all in my different funds, and I want to buy for all of them. And guess what? Our competitors are going to do the whole thing. We did this in March of 2020. We had to, because the market turned, we started getting money in, and we said, we got to go buy now because instead of cash going out, cash is coming in, and the deals are 10 times oversubscribed, and the spreads kind of ratchet in really fast. So liquidity makes spreads move out faster. It also makes spreads come in faster, given the lack of assets to buy, and there becomes this chase. And our corporate credit team says the market is grabby. I don't really use that term, but they say the market feels grabby. Everyone's trying to grab assets and find assets. So that's kind of one thing that could happen. One thing that I do worry about is that the market looks cheap, but if the fund flows turn, it's going to be very difficult to buy that cheapness that you thought existed out there.
It seems like the argument for understanding that you cannot bottom or top ticket, however you're going to look at things.
You can't get too cute, yeah.
Right.
You got to try to kind of buy on the way down.
So many folks have asked, is it time to buy credit? Is it time to buy credit? Well, it could be. If you're underweight or you want an allocation relative to equities or whatever it happens to be, you start going now because you're being compensated.
And now you can, the barbell, you can buy credit. You don't even need to buy risky credit to get paid reasonable levels if you don't want to take too much risk. And now if you buy some longer duration safety assets like mortgages, agency mortgages, and or treasuries, you have yield there too, which you haven't had for a decade almost, outside of like a brief moment in 2018. And you would think that if your credit's going down because stocks are going down, which is what a lot of people are worried about, that now your duration assets, if you will, are going to be working for you, and they didn't work this year, right? Mm-hmm. Now, historically through time, the correlation of the safety assets, long treasuries and equities, is negative when CPI is less than 3, and CPI is not less than 3.
No, sir.
But if the market believes that it's coming down, inflation's coming down, then you could have that negative correlation start to kick in. Also, if the market thinks we're going to a recession, clearly that's going to bring inflation down too, right? Mm-hmm. And that's why you have an inversion, and that's why you need to respect the inversion, and that's why the inversion is actually the most that it's been in the last couple decades, here's the inversion of the 2s, 10s. Usually it gets to about negative, you can't see it here, but it's like negative 50 or so. It's only, it briefly inverted, I think, in 1998. And you saw in the late 80s, it got to, I think, about 50 basis points. And then it got barely inverted in 07. And now we're here at 70 basis points. This is the deepest inversion, actually, in, I think, 40 years.
I mean, the doomsday people are going to say...
Somebody put a bullet for me there in the last 40 years. I was just looking at the chart.
Thanks, Phil.
Thanks, Phil. Great job, Phil Goya, who some of you may talk to sometimes. And he makes a lot of great white papers and materials.
He does.
He helped me put this
team.
presentation together. We've been working on this all week while I was on the road. Me complaining about certain aspects of charts and him fixing them. I'm getting... I'm too detailed oriented now in my old age here.
Spend me a half an hour to delete all those emails from my inbox.
Yeah.
But the doomsday people on the last chart, we've probably already gone too long, are going to say this is the first time we've had inflation in 40 years as well. And look at how big that inversion got back then. That's going to be your tinfoil hat folk.
Yeah, rates were also much, much higher. So,
Across the board.
70 basis points as a percentage of where rates are today is much higher than where it was back then. And I don't know. Economy's slowing. LEI just came in more negative. There's pockets of the economy that are not terrible, but it seems like more and more data continues to deteriorate. Jobs market is still pretty strong, and that that's holding things up. And that's why many economists think the Fed probably has to keep going relative to where the market's pricing in today. But as we walked through earlier, I think there's a case that, that 4.5 on the 10-year is going to be kind of a ceiling-ish, unless inflation doesn't come down. So we'll see. Inflation should just roll over on the headline just on base effects as we roll off the high prints. So that's it. I did have some slides about the structured products market, but we ended up talking a lot about the structured products market. So we'll save that for another day. We'll keep this a little shorter. I think we ran longer than we thought we were going to.
Don't we always? Yeah.
But hope everyone enjoyed this. A lot of interesting slides, a lot of data. Hopefully this helps you as you think about investing in the bond market. Right now you can pick your risk appetite and you can find opportunities. It's not just... we had many moments where high yield looked cheap, but treasuries were zero, right? Not zero really, but close to zero.
Yes.
Now you have a double repricing in many pockets of the market, and I think it's a good time to go bargain hunting.
I think so, and I really appreciate you doing this from our conversation from last week when we decided to do it. I think recapping, something I'm not always good at, and what I keep thinking about this is taking the compliment. For the individuals who have more traditional type of assets in fixed income, look for the relative value within structured product. It's there right now. We just went through how many charts showing that it's there. It provides you lower correlation, lower vol, potentially, as well as attractive yields. And I'm just happy that after, Just Markets 2021, Just Markets 2022, where Jeffrey would go through this elaborate slideshow of how expensive equities were, and then he'd give the punchline of, but you know what's more expensive or more overvalued? Bonds. And that tone has completely changed, and there's an alternative now.
Absolutely.
So thank you for your time. Again,
thank you.
Early or maybe a little late, happy Thanksgiving when people see this. And to all of our listeners, thank you.
Thanks, everyone.